retail at the end of the day. You can get the right corner right, and the way the leases are structured could completely erode value, right? You could have an anchor that's not doing well. And by the way, that creates, critical capital risk. So you can get the location right, you can get the submarket right, and you can still have a drastically different outcome, which is very difficult for large investors to go, I'm going to put out $1 billion this year, but holy cow, each asset's different, even if on paper it looks phenomenal, which is where the operator, the manager, and the intel that we have comes into play.
Ryan, welcome to the show.
Hey, thank you for having me.
So in 2019, you started Last Mile. It's a time when everybody was focused on multifamily and industrial, and there had been a big cyclical rotation out of the retail space. Why did you start Last Mile, and tell me a little bit about the platform?
Yeah, seemingly crazy to have started a retail platform in 2019. I think for those that may remember, wildly contrarian, the need for brick and mortar real estate in question, and Amazon in 2017 buys Whole Foods. We're all pretty sure you're never going to go in a store again. Amazon's taking over. And then COVID hits, obviously, in 2020. Now everyone's 100% sure you're never going to go into another store. Well, we had a very different opinion. And, that different opinion was from decades and decades of retail experience, right? Not only investing, but operating, value creating, but more importantly, the relationships with the tenants. And so we have a relationship with every anchor. I had the fortune of being inside what I consider to be one of the best in class operating platforms at Phillips Edison. Several partners here are from there too. If they're not from Phillips Edison, they're from one of the other great retail shops. And our perspective in 2019 was very much that retail controlled the best real estate in the country, up on the road in the most trafficked locations. And you can look at it as retail, but really logistically, it's just a box. And really anyone that views the need to be the closest to the consumer as possible, right, began to be our tenants. And as we spoke to our tenants, we could feel this trend in 2019 of tenants valuing this real estate, wanting to figure out how to downsize to be in those type of locations. And then on top of that, so we obviously had a contrarian view from our experience, our intel, our relationships, that retail wasn't going to go away. But two, there became this great dearth of great retail managers. I'm not saying there aren't great managers, operators, value creators out there, but certainly in respect to the other food groups, far less. And there were no new managers created for the most part from 2010 to 2020, because why would you? You would have played the other themes. So we felt like there was a huge opportunity to step in. We felt like, in addition to a dearth of retail managers, having information that maybe what other people don't have that gave us convictions. We also felt like retail is one of the most misunderstood asset classes from a macro standpoint for the institutions and the investor, because of the nuance of leases and co-tenancy and the right corner, wrong corner, mid-block. And we felt like there could be a huge opportunity for us to build the next great retail platform with people that have been there, done that before. And so Last Mile was launched in 2019.
So you've referred to Last Mile a few times as a platform. So what does that mean? How do you think about the platform that you're building or that you have built over the last 5 years now? 6 years.
Sure.
6 years.
Yeah. We today are fully vertically integrated. I believe that can be an overused term. I believe there's one use of that term is we simply have property management, construction management, asset management, et cetera. Another is, can you truly create value in scale and not just operate in scale? And we firmly believe those are two vastly different things. But, today we own in 20 different markets. We have people in 6 different states, and both of those will expand drastically day by day as our platform continues to grow, our team continues to grow. We look about 12 to 24 months out on our needs, and we're constantly hiring around that. But today we value having a world-class investments team. So there is a complete dedicated investments team with analysts, with infrastructure, right? We have leasing, we have portfolio management, we have asset management, we have finance, we have accounting, we have debt capital markets. So every component that goes into creating alpha, how do you source all the way through execution, how you put your capital structure together, we had in mind when we built in 2019 and we have today.
So I want to unpack that a little bit because you said something earlier that retail is wildly or very misunderstood or one of the most misunderstood asset classes by institutions. What does that mean?
Yeah. Well, thematically, which is a term that's used all the time, institutions today, or just capital sources in general, are trying to put out more and more capital than ever with probably a more efficient team. And so they're trying to find these themes where they can understand them easily from afar and get money placed in large amounts efficiently with downside protection. And so think about multifamily. Does it really matter if you get the right submarket? Does it really matter if you're mid-block or on the hard corner or on that street or this street? Yeah, those are minor differences, but for the most part, you can get the submarket right. Retail, at the end of the day, you can get the right corner right, and the way the leases are structured could completely erode value, right? You could have an anchor that's not doing well, and by the way, that creates, critical capital risk. So you can get the location right, you can get the submarket right, and you can still have a drastically different outcome, which is very difficult for large investors to go, I'm going to put out $1 billion this year, but holy cow, each asset's different, even if on paper it looks phenomenal, which is where the operator, the manager, and the intel that we have comes into play.
So I think it's an interesting point because is this a mismatch in terms of capital sources and capital uses, or is there just kind of a continuum of education that is happening and needs to continue to happen on how retail can fit into an investor's portfolio?
Sure. Yeah. I think retail has been questioned on where it fits inside capital allocation. And, for the most part, because it's been in question, it's kind of been put on the sideline, which to be honest is what's created this opportunity to get into an asset class today. And, honestly, 5 years ago, it had been very difficult to get a lot of groups to speak about retail. Today, it's probably one of the only sectors, if not the only sector, that not only has a fundamental, meaning it's undersupplied, super high demand, low vacancy, and low capex, right? But you can get into that fundamental at a dislocated yield, right? Anything else that has those fundamentals, whether you want to talk about multi or industrial or build to rent or whatever it may be, you have to get it. You have to pay for it. There's already full fund flows. So what we call it is the capital markets. So retail today is one of the few opportunities the going in yield has become drastically dislocated from the other because of the misunderstanding, not necessarily because of the inherent risk, but because it's tougher for someone to put $1 billion overnight into retail. And so it's created almost a capital vacuum that allows you to come in and get some phenomenal returns on an asset class that is misunderstood. And so what happens is it's very difficult for the institutions that want to continue to do anything direct to get into it, which leaves a huge opportunity for managers to educate their capital, right, on something that's truly different, that truly has not only great relative return, but great absolute return. And managers are honestly beginning to see more and more of that inside retail as something they need to be in because they can get real alpha.
So when we think about alpha, there's, kind of alpha that you can get through better investment decisions and operations at the property level. And one of the major themes that I've seen emerging, in the conversations that I'm having with operators and investment managers is this kind of operational alpha at the property level, not at the investment manager level. That's related but different. And that requires kind of deep subject matter expertise versus what I might think of as the traditional allocator model, where you're really betting on the people and the teams who have the expertise. Where does last mile investments fit in? Are you boots on the ground? You really deeply understand how the retail works, the tenants, et cetera, or do you think of it as more you're partnering with operators who can do that work for you?
No. I mean, we are the operator, we are the executor, we are the boots on the ground, and obviously the team has been built with people with decades of experience. So not only is it our intel, our relationships, but it's our relationships. It's their intel, and we're constantly triangulating that. And so, but we've built it to be an allocator as well, right? We're taking advantage of thematics. We absolutely pay attention anytime we invest, especially in our funds. We certainly episodically or opportunistically invest, meaning an opportunity comes our way, and that could be a tenant gets us involved. It could be one of our local brokers get us involved where we can solve an issue, and that's just an opportunity, but it's not necessarily thematic. But in our funds, you will see us do things that are very thematic. And why a fund? Well, there's a lot of benefits to the fund, but also we do things inside funds where our investors benefit from owning more than one of those assets, meaning there's aggregation value. But today we have built out a platform where we're paying attention to where the tailwinds are in the world, for what type of retail is mispriced, misunderstood. Where can we back up the truck and really get a large portfolio built that creates huge upside return with very low downside? And then we match that up with obviously the team that can execute, et cetera. But one thing I would also add is we're a very bottoms up organization. And so we do top down. We make sure that we're not going against. One thing we don't do, I don't care how good the opportunity is. If I don't believe in the submarket, we're out. We don't fight macro headwinds, right? Don't try. Don't think you're smarter, right? It's not a good risk. But for us, for us, I bet you more of our deal flow. When you think about 200 million of equity that we've placed in the last few years alone, whether it be inside the funds or out on behalf of varying investor groups, I would tell you more opportunities than not have come outside of our investments team, meaning it came from our leasing team on the ground saying that asset right there is being underleased. We should pay attention to it. Our asset management team that's working on a value add deal, they get to know a market so well. Holy cow, we've uncovered something. We should pay more attention here. How do we quietly start to get our hands on more of that? So when I say bottoms up, so many organizations forget to be listening to the groups that are on the ground, right? Marrying that up with good discipline, good strategy from the top down, right? Because they bring opportunities sometimes where we say, hey, look, I get it. Too much capital risk for the return, right? I agree that it's a great opportunity, but we're seeing better opportunities somewhere else. And that's the beauty of having enough deals to look at is, that's a good deal, but it's not good enough. And so really, we consider ourselves to be very much a top down, but also equally a bottoms up kind of organization. That's been one of the biggest things we've worked on since 2019 is never letting go of that inside of our culture. And it's become a big differentiator.
You're the first person that I've had on the show that I think is mentioned or connected having boots on the ground and enabling them to share information up through the organization that leads to either risk mitigation or the ability to find new opportunities. How do you instantiate that into the culture? I think that's the holy grail of what a lot of people are seeking, but for a variety of reasons are not realizing the benefits of.
Yeah. It has been a mantra from day one that everybody needs to know our why. And there's a great line or mantra of the early founders in the early days of Netflix. And it was highly aligned, loosely coupled. And meaning, does your team know your why? But it's beyond the why. Do they know exactly, does your leasing team, most leasing teams are just told what to go lease, right? Do they really understand and what it is we're trying to accomplish? And what we're trying to accomplish is get into great real estate with low downside that has upside that we know how to unlock. It's that simple. And so think about it. Your leasing team is already having 100 conversations a week. I'm not asking for them to have any new conversation. I'm just asking for you to add a growth component to that. And it's the same thing for portfolio management, for asset management, et cetera. And so we've seen, and we've just been lucky enough, I shouldn't say lucky, but incredible people that buy into that culture, that buy into no one department is more important than another, right? We've always, anyone that is listening to this podcast right now has been inside those organizations where that one division gets more publicity than another. We have what we call the circle of life, right? The acquisition team is benefiting from capital that was raised based on the operating team's success of producing an amazing track record, being directed by a finance team that makes sure your operating team is constantly looking forward, knows where to go next, and is never questioning to maximize IRR, reduce downside. And it's this circle of life that we put up in every strategy meeting, every year-end meeting, every offsite that we do. It's this culture of people understanding exactly, right? Hey, you're touching people that have information. You're touching people that have intel, right? How do we? And so, we constantly, and I can't tell you we always have it perfect, right? Because it's, how do you then get that information up? And hey, acquisitions team, I know you're slammed. How do you not let that information sit on the sideline, right? And how do we act on that? But I would just tell you, it is a constant focus, but it's all about the people. And when we hire people, are you collaborative? Are you hardworking, right? Are you a student of your business? Do you just want to be a leasing person, or do you actually want, right? And by the way, people are compensated on how we do as an organization, not just, right, their individual roles. But, we probably over talk about it, Brandon, but it's an important component that I'm so afraid to lose as we scale. You kind of become a victim of your own success, but we're doing everything to make sure that doesn't happen.
I think it's right to over talk about it. From my own lived experience, you can't say it enough, and you have to keep saying it, and you have to keep doing it, and keep saying it, and keep doing it. And it's those who can stay on that treadmill, if you will, that will succeed, because it's very easy to lose sight of what got you to where you are. So I love that. So let's fast forward to where Last Mile is today. Give me the quick kind of thumbnail, 30,000 foot. You mentioned the states that you're in, but in terms of kind of AUM or assets owned and the way that you invest, you mentioned funds, and it sounds like maybe you do some non-fund deals, but give me the kind of overview of the platform and how you're capitalized and the types of investors that you work with.
Yeah, sure. Happy to. We, as I said, we now own in, over, 20 markets. Our goal is to not own in every market in the US, but as long as we understand the market, we don't invest in anything that we don't have a detailed, intricate knowledge of. But, our backgrounds, our experience, and how we built up the team has allowed us to do that. And we believe in selectivity. I firmly believe on us being able to review thousands and thousands of deals every single year, not feel like we need to invest in any one market, and really let deals fall to us. So we don't chase anything. I kind of call it the SIF, right? Which is making sure that we're constantly identifying deals we want to own. We're putting it into what we call our hang around the rim list. And those are deals sometimes that come around years from now, or 4 years from now, or 2 years from now. But we keep adding to that, and then we've got a system. But yeah, we own in 20 markets. We're about $500 million in real estate today. We launched in 19. We launched our first fund, literally closed our first fund in March of 2020, which was just a phenomenal kickoff to a platform, with COVID hitting us in the face the very next day. But it made us better. And, we were able to pause. We were able to sit there and say, hey, we're not going to waste this time. So we began to actually just build pipeline, build assets, research, during that time. And we were able to hit the ground running. Fund one has been incredible. I don't think anyone believes that 2021 vintage is going to be any good, given that 2022 rates went through the roof. And I won't speak about returns, but we are close to going full cycle on that, and just been a absolute success story, for all involved. We moved to Fund 2 at $100 million target, and we were well oversubscribed, and we did a hard cap at 130, but we had more demand than that. But that was really what we felt like fit the opportunity set for that time. We always match pipeline opportunity. We don't just simply, maximize how much capital we raise. And we're 1 or 2 assets away from fully investing that, and we're now moving to Fund 3. And then along the way, some opportunistic things have come our way that we've capitalized, separately. But our core business those funds are all around what we like to call everything that we do is last mile retail. So if you think about subsectors, there can be grocery and power and lifestyle, and people play it differently: primary, secondary, right? Redev versus core, value light. But, from our standpoint, back in 19, we just thought the most misunderstood, retail in general was contrarian. And we felt like the most mispriced, the biggest opportunity at the lowest risk was really what we call unanchored retail. But we focus on last mile retail. Unanchored retail is a subset of last mile. Last mile retail are the best located assets on the highest traffic thoroughfares, near the gravity, meaning near the hospital, near the grocery anchors. The daily traffic is already coming to this corner, right, in the most coveted suburbs across the US. And that can be anchored or unanchored, but we love those locations. And those locations are what individuals and consumers consider convenient. It used to be convenient was online. When we're starting to realize convenient is also down the street from your house and increasingly where you work, right, in the best suburbs. And so there's a suburban play, there's a retail play, there's a convenience play, all within that. But those funds have been all unanchored retail. We've become one of the largest owners of in the country. We're incredibly bullish. We play it. We've been able to generate phenomenal risk-adjusted returns on behalf of our investors there. And, we intend to continue that series. However, we are also beginning to see a real opportunity in, anchored and grocery anchored redevelopment, just given the discussions we're having, with our relationships. They're in general, larger anchors kind of muted their growth for a lot of reasons in the last probably 10 years, but certainly post-COVID, as they're trying to figure out e-commerce, trying to figure out their supply chain, trying to figure out how the store fits in. Well, pretty clear the store is a critical component of distribution or buy online pickup or convenience of people coming into the store. And they are now very, very eager to start thinking about how they grow again.
I want to make sure I understand definition. So unanchored retail, best located asset near the center of gravity. Is this different? How is this, and this might just be my very limited understanding, how is this different than essential retail? Or how is it even different? Are we including things like strip malls in this? Or how are you kind of defining the buy box of the quality of the asset, the tenancy of the asset, the kind of the details of what does unanchored last mile retail mean?
Yeah. So last mile retail to us just simply denotes the location, right? Is it that suburban location at that hard corner where 60,000 cars are already going per day? It's stable, thriving. It's the daily traffic of where people in that 1 to 3 mile are going, and you can benefit. So really, and really the definition of unanchored is just simply buying things in that node that are up on the road, visible, accessible, right? That benefit all from that same traffic, but you don't necessarily control the anchor, but the location is your anchor. So oftentimes the Publix is right next to you, the H-E-B is right next to you, the Target's across the street, the hospital system's on the corner. So all the gravity is already there. You just don't happen to actually control the anchor. And the anchor is a big draw, right? One of the benefits of grocery anchored real estate is that you have, depending on the grocer, anywhere between 500,000 to 3 to 4 million visitors per day coming. Well, the unanchored asset is typically directly in front of it, directly next to it, right up on the corner, benefiting from all those eyes, all that traffic. You're not necessarily acquiring. And we can say why we like that. I'm happy to talk about the thesis and why we think that thesis is mispriced, higher growth, lower capital, fragmented, aggregation, potential institutional fund flows. I guess I just gave you the thesis right there. We can unpack all of that. But essential retail really can be anchored or unanchored. And really essential is, and this is what we focus on as well, which is a tenant base that does not sell a good, right? It's those services that you use and go to in good times or bad. So think about urgent care. You and I grew up, Brandon, right? Going to the hospital to get stitches, going to the hospital when you needed a flu shot. Where do you go now? You just go to the urgent care down the street from your house, right? We grew up going to the dentist at the office park. Well, you now just go to your strip center in the most convenient location with parking where you pull up, right? And they'll now think about Jersey Mike's and Domino's and, F&B, and think about vision. You no longer want to go to the mall if you don't have to. Why? Because you go to the mall for experience. You don't want to go to the mall to get your eyes checked. So now where do you go? You go to your strip center. So that's the definition of essential to me. And that's the nice thing. We can talk about the defensive natures of retail, but specifically the tenant base. These are tenants that are simply essential services and food that people frequent in good times and bad. So not only are you e-commerce resistant or Amazon resistant or Walmart resistant growingly, but you're also cycle resistant given the tenant base.
One of the things you mentioned was, potential institutional fund flows. And I wanted to make sure that I understand kind of the investor base or the composition of investors at Last Mile today. Are they, mostly, high net worth, private wealth? Do you have, aggregators like RIAs? Are you working with institutional investors like pension funds, endowments, foundations, all of the above, none of the above? And what's the composition?
Yeah, all of the above. All of the above. I would tell you we have an equal amount of institutional. I would put the next bucket into RIAs and family offices. And I would put the third bucket direct high net worth. So we focus on all three.
So setting aside the institutions, or we can come back to them, but my hypothesis is always that if it's something that's relatable, it's retail, we drive by it, we go to it for all these essential and convenience related needs. That's a little bit easier for the high net worth or private wealth space to understand. But I'm curious to know from you, is that true? Or are you still needing to explain kind of the underlying investment thesis to investors who are not institutional in nature?
Yeah, it's a very relatable. It's very understandable, right? And you get to brass tacks really quick with an investor because, right, there isn't a relationship we can't sit down with and go, well, talk to me about where you get your nails done or where you get your hair cut or the local urgent care down the street. Like they all have it and they go, I get it. Wow. And they immediately risk assess it as something that's essential in great real estate. And then we can get into the returns and the opportunity pretty quickly there. Yeah, it's not a very long discussion there. I would say that, our discussion, we have high net worth investors that are as sophisticated as an institution and how they want to dig into how we risk assess. How do we use capital? What's our duration adapted capital? What's the insurance, our program look like? How do we think about diversity? How do we think about our REIT structure? And love it, right? Because as someone that's already thought through all that and wants that to be a differentiator, we want all those questions asked because we can walk you through how we think about downside protection, how we think about your capital. Because guess what? When you have a discretionary fund and there's years and years of placement, years of harvesting, right? Things happen in the market and they need to know, that we're thoughtful about those and not just thinking that everything's going to go to the moon, which we don't. But it's interesting. We've got every institutional discussion is different. Every RIA discussion is different. Every family office discussion is different, and every individual and understanding them personally and their motivations have been key to making sure that, we can make sure it's the right investment for them. And it's not always, but the beauty of those relationships are they far more appreciate when you understand that. And you can go, hey, but you know what? We're seeing other things out there. And as we get our arms around something and feel like we can recommend it to our investor, because everything we do is around where we're going to place our own capital, we think that may be a better fit for you. So stay tuned. We'll keep you posted. Not everything has to be a fit for everybody.
Yeah, I think that's a really important point is, meet the market where the market is versus, force the product that you have today down, the throats, if you will, of somebody who doesn't really want it. When you think about getting institutional fund flows as a parallel, one of the challenges in the segment of retail that you're in has always been the fact that it is disaggregated. And you talked about that as one of your, part of your investment thesis is that it's disaggregated. So let's spend a minute, just help me understand how you are using disaggregation as a lever to both attract capital and create value.
Yeah, sure. So when it comes to aggregation, there are some very clear parallels in other sectors, right? So think about, it's no different than all the different subsectors of multifamily you have today, whether it be, and they all have some of their own individual theses, but the reality is, think about single family rental, right? Single family rental came out of the themes around rental housing were undeniable. There was so much capital going into the space that it was priced like it was undeniable. And people were trying to find a better capital markets opportunity, i.e., better cap rates going in, entry caps that benefits from the exact same secular tailwinds a la single family rental, right? Now, the strategy, the difficulty there is it's operationally intensive. It's small assets, right? And the moat around that is just how difficult it is. And so this is no different. But now you can see how when you build a $500 million, $1 billion portfolio of single family rental, and probably doesn't even need to be anywhere near that size, you clearly have cap rate compression as it relates to just being able to aggregate a portfolio. Now, a lot of people, it's a big misnomer in that you aggregate a portfolio of anything and it'll be worth more. Not true, right? You need to understand what the institutions are looking for, right? What kind of demographics? What does the dashboard look like, right? What markets are they focused on? What incomes are they focused on, right? What kind of tenant base are they focused on? And so are you making sure that the portfolio is adding up to what will be attractive to the institutional capital after it's aggregated? For us, we underwrite every single deal under what we can control. So every deal has to underwrite as a going in cap equal to the exit. Sometimes we expand it even, depending on the opportunity. And then what we can actually get to, meaning what is the opportunity, whether it be lease up, re-merchandising, capital investment, leasing spreads. We've got a variety of obviously value add strategies that we see and employ and execute. And then what happens is the aggregation just becomes gravy, where a lot of people really get themselves in trouble as they go on a mass buying spree, and you need the capital markets execution to get out of it. There's a blip on the radar. There's a pullback in the economy, things that we can't control. You can't necessarily foresee, even if you think you can predict them or you're seeing them coming. You don't know for sure. So you have to have always these defensive characteristics in everything you're doing. You can't get too high in the good times. You can't get too low in the bad times. And so what we do is we underwrite deals, to obviously getting into the double-digit returns just on what we can control. And then you let the aggregation be gravy on top. You let more institutional fund flows, right? In terms of, hey, just more people interested in scaled portfolios, which is absolutely happening in retail, not just in unanchored. There's actually multiple transactions going on right now and in the last 6 months that are proving out investors' interest in scale in retail. But the aggregation of quality retail, whatever your definition of that, has real value to it.
So let's shift gears and talk about a few of the themes just from a secular and a fundamentals perspective. A lot of people, I think we're beyond the, technology and, e-commerce is going to kill retail ideas. And you've talked a little bit about why that isn't true, but what are some of the other kind of macro themes that are, tailwinds for the sector right now and that you anticipate will stay in place for the foreseeable future?
Yeah, I mean, number one, I've already spoken to, so I won't belabor the point, but it truly is the best real estate in the country. Like, walk around, it's not mid-block, it's not tucked back behind, it's literally up on the road, visible with parking. And we can get into access and whatnot, but it truly is real land value. Not just land value because there's a building happened to be sitting on top, real land value given those type of locations and what that real estate controls. So one, I think I can't pin that point, overall enough. Two is this definition of retail. And people are like, well, where's the demand coming from, right? There can only be so many Jersey Mikes or Orange Theory Fitnesses or whatever it may be. And the reality is it's no longer traditional retail. Anyone that values being close to the consumer with parking is looking at these centers. So actually the demand's not only going through the roof, rents aren't just simply going to the roof because of the lack of supply, right? It's going through the roof because the types of tenants is broadening, not just deepening, but new tenants that were looking at office or inside the hospital or inside the mall. But anybody that has a business that's consumer facing.
Can you give me a few examples of, consumer facing businesses that traditionally you wouldn't have seen in retail that we're either seeing or you expect we will start to see more of going forward, besides the sandwich shop, the gym kind of stuff that's already here?
Yeah. I mean, I think the urgent care is a big one, but we can talk about urgent care, but urgent care is also a result of the hospital system wanting those type of things done outside the hospital because they're running out of space. They want higher margin things done in the hospital. They're running out of real estate. Plus, they needed to be closer to the consumer. They're fighting the other hospital systems over, patients, and, it's competitive. So they all want to, put something close. But think about therapy, right? You no longer actually go back to your hospital system for therapy any longer, right? Why? Because you go there to get major things done, whether it be see your doctor, whether it be get a surgery. Otherwise, you want it done directly next to, where you live, or hyper convenient. And we're seeing this in massage. We're seeing this. And by the way, there's the old stalwarts, right? I mean, you still get your nails done, right? In good times and bad. You get your hair cut, right? The Orange Theory Fitnesses, of the world. But I would say those are pet, right? There's a huge surge in pet, and there's no real reason you should go to that obscure building back over there. They want to be right next to where you're already driving every single day. And so honestly, right now, less than 7% of our tenants across the country actually sell a good. And those goods that are sold are like jewelry, where it's more service, right? Yes. Can you get a diamond online? Yes. But you go in there, you have a relationship with the jeweler, you need to get educated. How can I think about this for my wife or for my husband or whatever it may be? Fleet Feet, a great example. People going in, I have foot problems, I want to keep running. It's service first. I would tell you also, the question is, where are sales coming from? So people are like, is a lot of these restaurants are becoming commissaries. So think about it. Jersey Mike's, Crumble Cookie, right? They are no longer confined. So their sales used to be confined by how many people can come into the four walls, sit down, and eat. It now, with DoorDash, they're delivering more than people are coming in, right? People are buying online and just picking up quickly. Or it's such a convenient, visible location. They're going, oh, there's a Jersey Mike's, I'm going to go pop in. But reality, there are no limitations on what a sandwich shop or a pizza shop or what these QSRs can do, because it's now just a kitchen that's not restricted by its four walls. And why? They want to be in those hyper convenient locations where there's 10,000 houses, 60,000 cars per day, because it plays to all those different components I just mentioned and how they generate sales. And then there's the undersupply. And I would tell you probably the undersupply is something that you're hearing across a lot of strategies, but probably the most misunderstood is that retail's been undersupplied for 15 years. This isn't it was undersupplied for the last 2 years or when rates went up. Go back and look post GFC. From 2009 on, it has had somewhere between, I'm going to get this wrong, but directionally correct, 10 to 40 basis points of stock built, where it's historically been 1% to 2% for 15 years. We are somewhat undersupplied. We are drastically undersupplied, especially when you think about the locations I'm talking about. By the way, there's going to be some retail that's going through challenges, and I'm happy to talk about that. It can be location driven, it can be tenant driven. Again, going back to the nuance of why it's tough for people to access the asset class directly. But this thing, I mean, retail in general has been undersupplied for almost 2 decades.
Can you just touch briefly on malls? I know you don't cover malls, but kind of what's there was kind of the rise and the fall of the mall, in very kind of generally understood. And then you've got kind of the rise of the lifestyle center. You talked a lot about experience. You talked a lot about service. Is there any correlation between the performance of, the traditional lifestyle center, if you will, and how last mile retail performs?
Yeah, I mean, I'm not sure there's much of a correlation other than Everything in the middle is what is struggling. So if you're a lifestyle center that doesn't truly provide that experience, whatever that is, and maybe there's lifestyle centers, we're not experts. You will not see us going into lifestyle, or malls. But my high level opinion, and we have a lot of good friends that do and are fantastic at it, is your mall better provide the experience. Your lifestyle center better provide the experience. And what I believe is not that what's going on in the malls or what's going on in lifestyle, but each market, whether it be California, whether it be Cincinnati, or whether it be Atlanta, right, needs great experiential retail. That can be lifestyle. That can be mall. Atlanta can handle more of them, but you better provide a great experience. I mean, some of Chicago's best malls are outdoor malls. Absolutely crazy to think in Chicago. But the reality is, just think about those two in one vein, which is they're fighting over being the great experience in a market, and there can't be an infinite amount of those, right? Where our segment, you need the last mile retail for every neighborhood. So you can have, right, 40 great nodes in Atlanta. You can still have, are there more in Atlanta than there are in Cincinnati? Yes, but there are still 20 great nodes in Cincinnati where you may only, on the experiential side, they may be fighting over there may be room for 2 in total. And if you're caught in the middle, you're a commodity location, or you just haven't been able to attract that right merchandising experience, those are going through some severe trouble.
So I want to change gears for just a second and talk a little bit about the platform that you're building. You and I have had many discussions over the last, call it 18 months about, the importance of, getting the foundation right, attracting and retaining the best people, and then building something that has long-term value, that's durable, that actually has enterprise value. Maybe just, let's talk about how that sits with you, and how are you thinking about, building last mile so that you can achieve, your vision, which I think you said is to have a platform that exists 100 years from now that is strong or stronger than it is today.
Yeah. The vision of this was to truly build a platform that wasn't one guy and his ideas and the execution of those ideas. It was truly to build a platform. And, our focus is that, our leasing team is creating alpha. Our investments team is creating alpha. Our portfolio management team is creating alpha. They're not just simply being directed once a deal is bought. So the investor is our North Star. And before every single investment, every single new fundraise, right, any major decision, it is about how this will affect the investor, what will be the result, what are the stress tests, what could it look like over the next 7 years, right? And we look at everything in a range of outcomes. Everything's a range of outcomes. There is no model that's correct. You have to look at everything, and you have to be honest about the downsides. And if there are situations that we don't control that could cause principal loss, there is no investment vehicle we have, right, that would fit, even in our opportunistic buckets. But that takes an overall team. Our investments team at this point are infinitely better than I could ever be at investing. I mean, they live it, they breathe it. They're off market channels, they're in market, they're using data, they're using old relationships, they're using all different kinds of strategies to mine new deals, mine existing deals, and understand where we should be spending our time. And they are incredible at that. And he's in charge. I mean, we have an individual that runs investments. He gets to make people decisions because he is held accountable for the alpha he's created. Your job is to not just source and then tell the operations team they should do better. Your job is we separate everybody. We don't allow, and you see this inside of organizations, we do not allow the operations team to say the investments team should find better deals. We don't allow the investments team to say the operating team should get more aggressive on rents. Everybody is responsible for their own alpha. And when you do that, the investments team starts to realize, you know what? We're not here to just simply get into what everyone else is getting into. How are we digging out really unique ideas? And that's when you start to see them work together. Hey, leasing team, will you go on this trip with me? I'm really thinking this node may be something that's up and coming, or I got a hint something transformational is happening. I would love your perspective on this, right? But, the operations team, right? Your job and leasing team, asset management, portfolio management, each one of those are individually responsible for their own alpha. So keep layering alpha on top of alpha on top of alpha. And then I would say lastly is our finance team. I almost view them as internal asset management. There always is this conflict between finance and ops. Ops gets mad. Finance doesn't understand. They've never leased a deal. They've never done anything, right? The finance team, the ops team doesn't understand that we need to generate great returns. It's not an adversarial relationship. They are actually simply internal asset management and external asset management. You have your people. When you have a leasing team, do you ever want them wondering what they should be focused on next? No, you have an internal team that's constantly their partner, looking ahead, providing reporting that goes, guys, you have the ability to cure cancer. Why would I ever ask you to do anything but cure cancer? Go get 80 deals done. Without me, you would have only done 40. Hey guys, we need to, the biggest IRR lever in this deal is coming up 14 months from now. It's going to take us 6 months to get done. Let's start now. So many firms work super hard and they're like, we worked hard and it still didn't add up to success. You didn't look ahead, right? Because when you have great people, but I would tell you that is for us, that has nothing to do with me. That is having an initial vision, people buying into that vision, being absolutely just maniacal about keeping that vision and not letting scale turn you into, right? My ops team doesn't talk to acquisitions, doesn't talk to leasing, and they just kind of do their roles. And I guess it adds up to success. No way. And so I mean, the proudest moment I'll have is the day where there's succession inside this company, right? Because our alpha comes from the people running those organizations, them buying into our bar of excellence, into the collaboration. The investor is the North Star. But there is not a fund we raise that doesn't start with quarters and quarters. I mean, we have multiple things in research and development right now, right? Nothing we do is overnight. Oh, we should go raise a fund around this. It is quarters of underwriting deals, tracking things, building convictions. And before we ever decide to go big on anything, we have already been tracking it. We've got a few things in the works right now that we are about as bullish on as we are anchored redev and unanchored. But that is a testament to the organization. Yeah. And, there'll be a day that I hope I do this again with you, Brandon. And, I may be in a different seat. You don't know.
I love that. Well, that's a great place to wrap up. For our listeners who want to learn more about Last Mile Investments, they want to get in touch with you, a member of your team. What's the best way for them to do that?
Yeah. I mean, we can share, you're more than welcome to share my email or go to our website, lastmileinvestments.com.
Awesome, Ryan. Well, congrats on what you built so far. Super excited to watch you continue to grow from strength to strength. Like always, I enjoyed our conversation today. So look forward to the next one.
Hey, thank you. And kudos to you and what you guys have built. It's a real honor to be on here.